Good morning, good afternoon, good evening, everyone. Welcome to our latest seminar. My name is John Turner from the Queen's University Centre for Economic History, and it's my pleasure this afternoon to introduce Chenzi Xu from Stanford. Chenzi is going to be talking this afternoon about national banks and the local economy. Those of you who are not familiar with her research, check out her webpage at Stanford. She has an amazing paper on the 1866 crisis and its effect on international trade. So the rules of engagement this afternoon, Chenzi is going to speak for 40 minutes. If you have questions, can you please put them in the Q&A function? And then I will be posing those questions to Chenzi after the 40-minute mark. And we will be finishing on the hour, but again, our usual practice is to continue on for 15 minutes for those who wish to stay on and ask further questions to our presenter. So without further ado, Chenzi, you're very welcome, and we look forward to what you have to say to us this afternoon.
All right. Thanks so much, John, for the introduction, and thank you for the invitation to present. It's really nice to be here. John was actually hosted me for one of my very first seminars, so it's really nice to be back in this same space. So this is a paper about the US banking system in the 19th century, and it's joint with a friend of mine from grad school. Okay, so this paper is broadly motivated by two strands of the literature. The first is this observation and the work surrounding this idea that economic activity, both within countries and across countries, doesn't exist in autarky. And so we know that physical infrastructure technologies help to lead to market integration and economic development. And this is seen both in emerging markets today, as well as at various points in the US in the past. But physical trade costs are typically understood to be a very small component of overall trade costs. And this goes back to the seminal work by Anderson van Wynkoop, for instance. So this idea that non-physical trade costs will matter for interactions between economies and for economic output more generally leads me to my second strand of literature, which is the idea that financial markets are really well positioned to lower specific types of trade costs. And so in prior work, I've looked at the direct financing channel, building on work by, for instance, Kalina Manova. But in this paper, what we'd really like to do is introduce the addition of indirect channel of financial intermediaries as a source of liquidity creation. And this idea that financial intermediaries can create liquidity goes back to Gorton and Panacci 1990, where they show theoretically that banks are particularly well positioned to issue riskless liabilities because they can repackage the stream of payments from their various assets and guarantee this payment for their liabilities. And the fact that these liabilities then become riskless creates liquidity that leads these liabilities to be a really nice source of transactions medium. Okay, so basically what we want to look at is this these securities that have a lot of liquidity attached to them, which can be used in payments and essentially lower trade costs associated with payments. From the perspective of a particular economy, where we think of this as translating into a place having higher market access. So in this paper, we're going to use the US National Banking Act of 1864 as a historical laboratory to try to answer this question. And in particular, we want to bring in this idea that bank-created liquidity, in addition to direct credit, can impact these trade-related types of local economic activity. And there are a few empirical challenges as usual. So first, financial markets aren't randomly allocated across space. This is something we're all pretty used to thinking about. And second, non-credit channels are typically difficult to observe, precisely because they're not balance sheet items that you can just record and look at. So in order to try to get at both of these challenges, in this paper, we're going to leverage the institutional context of the National Banking Act itself, where the regulatory capital requirements for establishing a national bank is going to be the source of exogenous variation for a local economy gaining one of these banks. And the specific institutional differences between national banks and the types of banks that existed beforehand is going to bring out the different types of non-credit channels that usually we aren't able to observe very well. Okay. So broadly speaking, this was an act that was passed to create better capitalized banks. So there was definitely this view towards stability, which is something Mark Carlson's paper looks at directly, along with creating a new uniform currency with a specialization in lending to the non-agricultural sector, particularly through what they consider to be safer, shorter-term credit. Okay, so these three components of the institutional detail lead me to go through each of these one by one. So for the better capitalized banks, we're going to use that as a source of identification. And I'll describe precisely where that comes from. For the uniform currency, this is where we're going to introduce this idea of an indirect channel, where this is the source of the liability side related changes to a bank's services. And finally, in the non-agricultural emphasis, that's where we're going to try our best to separate out this direct channel, where some sectors of the economy were able to get the loans that we think of as being on the asset side separately from other sectors of the economy. Okay, so I'm going to go through each of these one by one and come back to this slide with a summary of what things look like before the National Banking Act and what it looked like after. All right, so first, in terms of the regulatory capital requirement, this was established based on the population of the town that was published in the most recent decennial census. So broadly speaking, the idea is that places that are bigger are going to have a lot more economic activity. And so the banks that are supporting it should be better capitalized, and that will make them more stable to service this economy. The way they actually implemented meant that there were these very stark discontinuities if you were to look at these requirements per capita. So very concretely, towns that had a small population of fewer than 6,000 people had to create banks that had at least equity or capital paid in of $50,000, whereas once you cross that threshold, the capital stock doubles. Okay, so we think this is a pretty binding constraint for bank entry for several reasons. So it's very well known that the US banks in this earlier period were unit banks where they weren't allowed to branch. And it's also written in the National Banking Act itself that there were specific residency and investment requirements for the directors of these banks. So the directors are the primary people who are going to be raising this equity and paying it in. And they had to come from at least close to this town, and they had to, and a certain number of them had to be in the town specifically. Okay, so this was also not a very small number during that period. $50,000 roughly translates into 140 times the annual manufacturing wage. So these were fairly large institutions that were going to be much better capitalized than the alternative, which were known as state banks. So these were banks that would have been regulated by the local state authorities, and they often had either no capital requirements or very low capital requirements. So this either you converted your old state bank into a national bank and had to raise this new equity, or you're going to create a new national bank and again had to raise this equity. And this constraint was going to be face a big jump right at the 6,000 mark. Okay, so the way we construct our sample is to take, for instance, towns that look very similar in 1870. And we start with 1870 for a few reasons. The National Banking Act was passed in 1864, but we wanted to go significantly a little we wanted to go past the Civil War. And also there were some adjustments to the legislation of the National Banking Act that passed in the early 1870s that kind of changed the profit structure for these banks. So once we go past those, adjustment periods, what we do is we look at the 1870 census and we focus on towns that look very similar just from a population standpoint. So these are all towns with fewer than 6,000 people. And so they all similarly face the low capital requirement. Having been on this side of having low capital requirements, they also, as of 1875, don't have a national bank. So what we really want to compare are places that end up getting their first bank versus places that don't end up getting a first bank at all. And the reason we want to focus on this first national bank is because that's when we think the biggest effect will be from being part of this system where you'll get all of these different institutional characteristics of the national banks that I'll talk about in a couple of slides. Okay, so we have this set of towns that look very similar in 1870. And what we do is we then track how much they've grown into 1880. And we require that as of 1880, their population is still within this bandwidth of 4,000 to 8,000. And that's just a further restriction so that the places we're comparing look fairly similar on observable characteristics and are more likely to be similar on unobservable characteristics. Okay, so once we've done this restriction, I think the instrument becomes very clear, which is that the towns that cross the 6,000 people population threshold are now going to face those exogenously higher entry costs. And we'll also follow Mark's paper and control for unobserved differences in the growth trajectory with the population change from 1870 to 1880. So stepping back, the identifying assumption that we're using is that essentially there's no other concurrent change from 1870 to 1880 that would affect these smaller towns below this threshold in a way that might matter for their future growth and trade-related activities. So one example you might think of is, for instance, if there were different tax regimes for smaller places that were just at this threshold that were introduced in 1880, then that sort of change would be the types of things that we would be concerned about. Okay, so in order to build the data for this instrument, we go to the PDFs of the original censuses in order to find the smallest level of the town that's written down. And the reason we do this is because it turns out that the legislation is somewhat unclear about what counts as a town. And so from the perspective of a banker who's trying to raise capital, the smaller unit that you call your town, the less capital you had to raise. And so just looking at the actual records of where banks were established and the populations of the towns they were in and what the capital requirements would have been, it's pretty clear that, given the choice between some higher unit of a town versus a smaller unit, all these banks chose to be part of the smaller unit. And so that smaller town unit isn't always something that was collected in the historical census data that's easily accessible through IPUMS, for example. So we go through these various decennial censuses to collect the set of towns that we think would be part of our sample. And then we go through the annual report of the OCC, which was the regulatory body for national banks, in order to collect where these national banks were operating in, for instance, this town of Canton in Massachusetts. And because we have these annual reports, we can see when banks come in, but to begin with in our baseline, we only worry about whether they were there in 1875 or not. Obviously, these balance sheets have a lot of other information, and that's been nice for verifying how important, for instance, legal tender and other types of currency was for these different banks. Okay, so at the end of the day, we have these towns in our sample. And if we break them up, we have the ones that are in blue that were way smaller in 1880, so they didn't cross the threshold, and the ones in orange that did cross the threshold. So what we'll be doing is we'll always be comparing within a given state the places that are in orange relative to the places that are in blue. So the first stage for that comparison is the following regression, where on the left-hand side, we have this indicator for whether a given town I in state S has a national bank at the post period. So again, for the baseline, we choose a post period of 1885, but we can choose earlier in the decade or later in the decade, and the results aren't too different. And we look at the relationship between that and an indicator for whether the town was smaller, i.e. below the population threshold. We can control for some, observable characteristics of these towns. And as I said, we'll always include state fixed effects. Okay. So the bottom line of this, regression is that places that were slightly smaller, that hadn't grown as much into 1880, were about 30 percentage points more likely to get a national bank in the post period. Okay? So that's our first stage for thinking about how important were these regulatory capital requirements in having a local economy gain access to this new type of financial intermediary. We do a first stage falsification test where we're basically just trying to ask, maybe it's something about being very small or something about being in that general vicinity of 6,000, but not really the cutoff itself that matters. And so what we do is we create a lot of different placebo cutoffs, and we say, let's pretend that the actual cutoff was at 5,000 people or 5,500 people or 7,000 people, and let's estimate the first stage that way. And what we would have been concerned about was if these other placebo cutoffs seem to have had very high placebo first stages, right? In that case, we would think that maybe it is something about general size as opposed to this particular regulation. But what it looks like is that it is really the true cutoff that has a very high predictive power for getting a national bank in the first place, and not really these other indicators for size. Okay. We also do the standard thing of looking at balance on observable characteristics. So these all come from the census, and they look at characteristics in 1880 and 1870 and the changes between them. And of course, we've constructed our sample to, be places that look very similar. So we should expect this type of balance. But it's meant to give us some sort of reassurance that if the observables look very similar, then hopefully we're not too worried about unobservable differences. Of course, those are unobservable differences are always the possibility of those will always be in the background. So that's not something that we would be able to directly address, but this is kind of the standard way of thinking about what potential unobservable bias there might be. Okay, so I just went through this first bullet point on better capitalized banks. And essentially the summary is that before the National Banking Act, banks tended to be chartered by states, or they didn't even need a charter. And that meant that they had very low or even non-existent capital requirements. Whereas afterwards, the capital requirements for this particular bank was much higher and was tied to the local population. Okay. The next bullet point I'm going to discuss is this introduction of a uniform currency. Okay. So prior to the National Banking Act, the money supply in the United States was comprised of what were known as state bank notes. And so these were just privately printed notes that were backed by the original bank that had had printed them, and they were known as state banknotes because they tended to be regulated by their states. Here are a couple of examples of them. And as you can see, they're very non-uniform in all sorts of ways. They came in different shapes and sizes and denominations. And there was a lot of uncertainty about the actual value of any one of these notes. Okay, so first, they were not legal tender and they were only redeemable at the originating bank. So you could only take them in and get something real for them if you, for instance, if you had this banknote of South Carolina and you were in Georgia, if you went all the way back to South Carolina. So there were these physical transportation costs associated with converting a note into something that would actually have real value. There was also, as is understandable, a lot of uncertainty about the value of any given note that comes from this risk of counterfeiting or even of bank solvency. So, if you're in Georgia and you have this Bank of South Carolina note, you don't really know whether this is a real note, whether this is a real bank that exists. And you don't know if by the time you get this note back to South Carolina, whether that bank will even be around and would be able to redeem this note, even if it weren't counterfeit. Okay, so this means that, as you would expect, if you were a merchant, you weren't going to be taking any notes that were from a place that you didn't recognize. And instead, what you had was this profession of money changers who were essentially meant to understand the different notes, and they would charge a markup for essentially converting the non-local currency into a usable local currency. Okay, so these frictions of transactions coming from the currency itself were very salient. And I always like this story because it's amusing to begin with, but also it just illustrates the extent of the frictions that existed even between very close places historically in the US. So this was a guy who says, I started off in Virginia, I had Virginia money, and then I had to exchange that for shin plasters, which are just very small denomination notes, and some note from the Bank of West Union. And then in Kentucky, they wanted Virginia money and couldn't get it, went somewhere else, and then neither Virginia nor Kentucky money was taken, and on it goes until finally he reaches the end of the day and he has no money that anyone wants to take. And it is comical, but also a pretty severe illustration of how difficult it was to exchange in this system. Okay, so another way to see these frictions quantitatively is looking at the actual note discounts. So this would be how much of a haircut you would have to take on a particular note from these different states, so Mississippi, Alabama, Louisiana, Illinois, if you wanted to use it in Philadelphia. If you wanted to convert it with a money changer in Philadelphia in 1850, you would have to give up about 60% of the value of the nominal value of a currency. A Louisiana note had a much lower discount, but the point is that these varied both temporally and across space, and there's a lot of uncertainty tied to it. So what we see here with this huge spike with Illinois is that a large company in Illinois went bankrupt, and there was a lot of concern that banks in Illinois and Chicago had financed this company and so had a lot of bad assets on their books. And so suddenly people were much more worried about the safety of the notes that they were holding. Okay. All right. So in this context of this very illiquid local currency, one of the driving forces of creating the National Banking Act was, as Senator John Sherman put it, this desire to have a uniform currency so that a bank bill issued in the state of Maine would be current in California, and that there would be no limit to its convertibility. Okay, so if we look at this map of national banks after this act was passed, what this means is that anyone who has a national bank in in this part in South Carolina would be able to use it in Chicago with no transactions costs, unlike what had happened before. Okay, so the way they made sure that these banknotes were safe and people wouldn't worry about whether the bank would be solvent or not was by requiring that each note be backed 110% in federal government bonds. And so this essentially meant that there was no default risk. And in fact, the process for receivership for these banks was such that the note holders were the first in line to get paid. So those liabilities were the first that were kind of insured in this process of being backed by government bonds. They also required that each note was redeemable at any other national bank. And so all of these trade costs, particularly over long distances, were going to be reduced. And the long distance ones were fractionally going to be reduced much more than the shorter distance ones. Okay. So the liquidity from this introduction of a uniform currency comes from two sources, both in the supply of this better quality transactions medium, as well as in this network effect of being able to use them in many more locations around the country. Okay. All right, so that takes me to bullet point number 3, where I'm going to rely on the institutional context where, again, it was written in the legislation what types of collateral and what types of lending these national banks could do. Okay. And this is where we're going to try to separate this direct channel of asset side related loans from this indirect channel. Okay. So very specifically, what's written is that these national banks couldn't have any real estate under mortgage or possess any real estate as a form of collateral, at least not for a period of longer than 5 years. And this was all written as a way to keep national banks from going into very risky and illiquid types of lending. Okay. In practice, what this meant was that the sector of the economy that held most of its wealth in land, which often was under mortgage, i.e. the agricultural community, was usually less able to get financing from these banks. And the way contemporaries describe it is that, there's a lot of need from the agricultural section for loans, but bankers don't service them because of the cost of examining titles, looking at the mortgages, getting into these regulations and seeing what is actually okay from a regulatory perspective. And so the narrative on this is that they're generally understood to have lent more to the manufacturing sector and larger firms and more with short-term loans. Okay, all right. So to recap on this overview of the institutional details, we have these 3 characteristics that we're then going to lean on for the rest of the presentation. Okay, so the mechanism that we have in mind for the real effect of gaining a national bank for the first time is essentially this improvement in local liquidity that is going to raise a local economy's market access. It's going to make it much cheaper for them to transact with markets that are farther away, which also has this network effect of being cheaper to transact with the ones that those markets were transacting with. And this is through those 2 channels of having a better supply of local currency, as well as the compounding network effects. And as I said, it's going to be particularly relevant for these non-local / long distance transactions. So this underlying mechanism generates a couple of predictions. So the first is that the traded sector should benefit more than the non-traded sector, because it's the traded sector that's going to see the bigger reduction in the cost of both its inputs and selling its outputs. This also is, broadly speaking, a force for agglomeration. And so we would expect that agglomeration and more firms would generate more product variety. And so that's something that we try to proxy for and look at as well. Okay. So in the last 10 minutes, I'll go through the outcomes that we look at in different sectors of the economy. First, agriculture, second, the labor market, and third, manufacturing and this product variety innovation. Okay. So when we look at the change in agricultural production between the decade that a place gets a national bank in the 1880s and the decade afterward in the 1890s, what we see is that there's pretty much no difference. So places that get a national bank aren't producing more in the agricultural sector. And we think, this is pretty consistent with limited long-term lending by the national banks to the agricultural sector. If we break down total output in the agricultural sector between different types of inputs, we see that there's no change in land and fixtures value. But what we do see is that the non-traded share of output shrinks significantly. So what we're doing here is we're looking at the different components of agricultural output, and we're classifying the ones that are traded on the Chicago Board of Trade as a traded product and the ones that aren't as non-traded products. This is a section of the paper where we're adding a lot of robustness and looking for different indicators of what should be considered a traded product versus a non-traded product, looking at the production capacity in different places and whether a product is very rare and therefore much likely to be traded versus less rare. And so what we have right now is a pretty consistent picture that if we were to think about the share of traded products, it grows in places that gained a national bank. Okay, so this is just a recap. This picture is just a recap of those three tables I went through. They're separately estimated regressions with normalized coefficients. And the point is just to emphasize that we don't see anything for total production or total land value, but we see this share of non-traded goods diminishing significantly. We then look at the labor market effects. And here what we do is we turn to different business directories that list the companies that are operating in each town. And we were able to find a directory that roughly is in the pre-period of the late 1880s compared to, a post-period of the late 1880s compared to a pre-period of the 1870s. And we create a proxy for places that have, for professions that are very transactions intensive as being very trade related. So the profession that we found that was most trade related was this profession of being a commission merchant. So commission merchants don't actually produce anything. They literally are just middlemen. And what we see is that these places that gain a national bank end up having a lot more middlemen advertising their services. Okay? This is very similar to the line buyers and shippers, which is collected in the Census of Population. We can also look at some different placebos for non-trade related professions. And so we do that for architects, for doctors. And what we're trying to do there is essentially find professions that would grow with the size of an economy, but aren't necessarily related to trade itself. And here we're very open to suggestions about other types of professions to look at. Okay. And then finally, in terms of manufacturing output, we see that there is a large increase in overall production. But this doesn't come from a change in manufacturing capital. but rather from the inputs per capita. And so this, again, these three sets of results where the output seems to be directly tied to shorter term inputs and outputs looks very consistent with this idea that they were able to source more of their inputs at a cheaper price, probably partly because of short-term credit from these banks, as well as these lower transactions costs. Okay, and finally, we take the number of patents as a indicator of local innovation activity and just try to get a sense of product variety. And we do see that there is this growth in product variety. I'm not going to hang too many hats on this particular result, but I do think it's pretty interesting and related to the things that we've been discussing. Okay, so again, just to recap, this plot is summarizing those results that I showed in the tables, where we see this increase in total production, and it is coming more from the inputs as opposed to from the capital. All right, so before I conclude, the outcomes that we look at are in the agricultural, labor, and manufacturing sectors. And broadly speaking, we think the agricultural results showing the shift towards traded goods is the strongest indicator that this liquidity effect coming from the liability side of the balance sheet had real impact, because this was a sector that got very little of the extra lending, whereas what we see in manufacturing and in innovation is consistent with the broader banking, the broader improvement in banking that happened on both the assets and the liability side. Okay, so in conclusion, this is a paper where we're trying to introduce this idea that indirect liquidity services can have real effects that we can actually try to observe. And we're doing that using this particular institutional context where we have a nice source of exogenous variation for access to financing and different changes in the characteristics of financing that help us to back out these different channels. Okay, so thank you very much. I think I ended just a couple of minutes early, but I appreciate your time and attention and looking forward to the discussion.
That's perfect. Thank you very much, Chinzi. That was absolutely fantastic. Really enjoyed listening to you. And now if people want to put in their questions into the Q&A function, I'll then pose those questions to Chinzi. Maybe I will abuse my privilege as chair and kick it off. So do you think you might be picking up effects that state banks are then bringing? Because the national banks come in, this pushes state banks to move away from issuing currency into deposits. And is that potentially something that you could be picking up in your analysis?
Yeah, so I think you're totally right that we definitely think of deposits as being a liquid, or certainly today we think of them as being a very liquid liability. That's something that we can certainly use for transactions through checks and other sorts of direct transfers. And in that sense, the size of deposits and how easy it is to use your deposits is something that we're not really observing, but could be there in the background. We have the data, thanks to Matt Jaremski, for the state banks that are operating in an area and their characteristics as far as he's collected them. It's a little tricky. I think we're struggling a little bit with how exactly we should be, quote unquote, controlling for these things, just because they may be, not the cleanest controls. But that's a level of heterogeneity that it would be great to look into more. But yeah, conceptually speaking, I think you're entirely right that when we are thinking about money more broadly, we don't have to just think about currency, and deposits for sure can be very liquid.
Yeah, and just to pick up on that, thinking of money more broadly and going to your previous work on bills of exchange,
Yeah.
we're bills. How common were bills of exchange in the United States at this time in terms of facilitating that sort of trade across state boundaries, etc.?
I think they were used. They were more used among the bigger banks. And so this is actually something that I think the national banks were going to be much, they had a better system for sending payments across their customers. I actually haven't seen much data for domestic bank bills of exchange, although I'm sure someone in this audience is aware of what that looks like. So would love to hear from you if that's the case. But I think going back to sort of what I was very loosely speaking of about national banks being a source of shorter term credits, especially to the manufacturing sector, what I had in mind was that sort of trade credit, trade financing that can be very short term and can be, for that's basically doing exactly what a bill of exchange would do.
Yeah. So maybe Ray wants to come in with a question at this stage. So Ray, if you want to come in with your question.
Thanks, John. Angela Reddish also had a comment before me, but I may as well. So these are related questions, right? So we know that there was a negative shock on the state-chartered banks because of the creation of national banks, namely because of tax discrimination on bills and so on. Mm-hmm. But then the state bank sector recovered very quickly, precisely by expanding its deposit bases. This is when checks become significant and so on. Right. So I guess the question here is external validity. How long do you expect these disadvantages to have applied relative to counties or locational towns that took longer to get their national banks or eventually didn't get them at all? The other thing is I really like your idea, and I believe it entirely, that unifying the currency reduce transactions costs, deal away with those complex discounts and very volatile discounts on out-of-state banks. But as your data shown, this was not a constant, right? So there were moments of financial tension where these discounts flared up, and then when you went back to normalcy, right? So maybe the problem was not the variety of the circulatory means. It was essentially the fact that there was no uniformization in financial regulation across states. Right? So perhaps the structural problem here is that certain states had better banking regulation than others, and that wasn't solved with the national banking sector, which just created a parallel system, right? I think if I can squeeze in a third final quick one, how about regulation on banks' balance sheets? So state chartered banks were a cheap way of state banks to fund themselves by forcing state bonds onto the balance sheets. The national banks was essentially the same idea. So how do you think about the relative ability of these banks to lend from the two systems given these constraints?
Thanks, Ray, for your comments. You bring up a lot of interesting points. So on your very first one on how long we would expect these effects to last, I agree with you that if we were to think of this as a world in which all that matters is kind of the level of the types of financial services that matter, then as soon as you get a substitute that provides a very similar service, then any difference between places should disappear. And I think, there's certainly that, and that force, I think, is certainly there. There is also this idea of early mover advantages and these agglomeration effects, and this the fact that if you do happen to be in a position where you can grow more, then that might compound more than that initial difference. So to me, it's not super obvious that we would expect everything to go away as soon as financial development evens out. But the empirical question of how long these effects can last is something that we can and we do look at in the data, and they do seem to be there for at least another decade. How much, and I think that's that's something that we can refine a bit better by looking at how much new entry there is post our initial shock, or whatever you want to call it. But you brought up, I think, in the second two about differences across states that really matter, whether this is in the stability of the state banking sector, or how much these banks were forced to hold, unsafe types of assets coming from their local governments. That is a degree of heterogeneity that I think would be really nice to look at. We restrict our analysis to being within state, but we can definitely think about ways to compare states that have a bigger delta with respect to the national banking regulations. So different ways of thinking about how bad an original state was. One thing we really wanted to do, but had trouble finding the data for, is in the original discount graphs that I was showing you, which I can go back to, everything was relative to Philadelphia, but these discounts are actually bilateral. So it actually is a between A and B sort of relationship. And that is really a nicer measure of the change in trade costs between places, which would be nice if we sort of knew outcomes between places. But ultimately, we weren't able to find proxies for what is trade between Alabama and Illinois? And so then we turned to these broader production level indicators for traded activity. But yeah, I think leveraging these differences in across states would help to think about the nuances of this policy a bit more.
Okay, we have a question from Angela Reddish. So Angela says that your example was of a local traveler, but you focus more on sort of international trade or trade more broadly. So she expects that trade would use checks and trade credit rather than the national banknotes.
Yeah. Okay. So I think what you're getting at is broadly this idea that maybe we shouldn't expect there to be much of a gap in. So I say that long distance trade costs are particularly affected because of these notes, and maybe we shouldn't expect that actually to be affected because there were already alternatives that were that worked well. And I think that even if there were alternatives, these weren't costless alternatives, and that trade credit and trade and checks and things like that, those were also things that national banks supported, and you can think of as possibly supporting better than whatever the alternative was. So I do think that there is still a delta. It may not be as big in absolute terms as going from infinite to zero, but even if there were alternatives, this was, I still think of this as an addition that would have still changed the trade costs.
Okay, next question is from Gustavo Leva. So he's basically asking, so you're looking, Chenzi, at the local level, at the town level, and changes at the town level. But he's wondering, is there evidence to suggest that there's aggregate effects in the time series for production employment coming from the National Bank Act? After all, he's suggesting that these are the sorts of things we would expect to see. So I know that's not the subject of your paper, but just in terms of more general.
Yeah. That's a really interesting question. And I guess it kind of gets at, do we think of this as, keeping the overall economic pie the same size, where the places that ended up being better financialized gained things from their neighbors and those neighbors lost out, or whether this just grew the pie? And we can look a little bit at spillovers. It's still going to be partial equilibrium. We'll still have to say, okay, here's a local shock, and let's look at let's look at what's going on with neighbors and see if there's a positive or negative, and that might give us a sense of whether there's more substitution or more growing the pie. But I think without an actual framework, it's a little hard to get at what the GE predictions would be here.
Yeah, absolutely. And then Stefano Bartolisi has a really interesting suggestion here. So he's saying that the increased efficiency of the payment system was driven by the integration of small country banks into correspondent relations with the big city reserve banks. And so he says the Rand McNally Bankers Directory, that has the list of names of banks correspondents. Perhaps you can then exploit variation in corresponding, not corresponding in your sample to, identify further differential effects.
Yeah, thanks for that suggestion. Yeah, if I understand correctly, the idea there is also this would be a way to observe what that delta and the trade cost would be just from some places. The alternative in the state banking network or whatever the pre-national banking options may have been better than others. And that's something I'm happy to look into. So thanks for that.
Okay, I've got a few more questions, if that's okay. So are you worried that your samples concentrated a lot in the Northeast? So if you think of the problematic, state banking systems, most of those were not located in the Northeast. So are you concerned about that?
Yeah, I think from a purely identification point of view, I'm not super concerned about it, but from a more, let's interpret the economics and understand what's going on there, it's not picking up as much variation as, a real geographically diverse set of observations would. And I do think that that's also a place where, if we were to look at the differences across states, they're probably actually going to be somewhat small. And so it's a little bit harder to, go down into the state level differences and try to say, okay, it's this margin of difference that's really that's really driving the effects. Yeah.
Okay, thank you. So Nathan, do you want to come in with your question?
Hi, thank you. Really like the paper. I haven't read the. Maybe it's my problem reading the paper, but in terms of the balancing, so you balance on a bunch of conditional bivariates, but I don't see some of your dependent variables, the outcome variables that you rate the performance of banks, the impact of banks on, like, for instance, the tradable people, workers in tradable occupations, etc. I mean, they're not the same controls, right? That you're doing pre and after, right? So you show us some impact of banking on some occupations and some within agriculture, but I don't see the sort of the pre-treatment.
The balance levels here.
Yeah, on these these variables. I see them on other variables, but not.
I see.
Not on these variables, and perhaps maybe sort of the population growth in the city or whatever came about through changes or not. I don't know of these specific variables. Like how does a town move from 6,000 to 7,000 or something? Is that because the non-traded occupations increase, and then there's some impact on the banking, or just if you can clarify a little bit of that.
Yeah. So we do. So I guess one thing conceptually to just clarify is that in a difference in difference setting, which is ultimately what we're doing, we don't actually need outcomes to be balanced across treatment and control. We just want the trends to be parallel. Of course, that being said, in a two-period diff and diff. You don't have much in the way of pre-trends, and 1860 is kind of a strange time to be comparing this period to. So I apologize for not having those balanced here in the levels. I think they did look very similar because, as I said, we're looking at such similar places that it would have been very surprising if population was, the components of population very different, but that is a possibility, and it isn't on this graph, as you say. In terms of, this sort of chain of events of what's really happening, that too is something where, we can think places that were originally more trade oriented may have had a different slope of a response to this same policy change to a place that was less trade oriented. I think there we might run into power issues. Again, it actually does look like the populations are very similar, but to be perfectly honest, I haven't looked at that, so I can take a look.
Thanks.
So it's just a comment in the Q&A function here from Youssef Galada. Basically saying when people are exporting outside of the United States, they're going to be using bills of exchange.
Yes.
Primarily on the using the London market as well.
Yes. Yeah, no, totally. And I guess this is one of those things where it would be nice to know exactly what of this, what component of output is going to international trade as opposed to staying domestically versus going in the rest of the US. And we do have data for the product composition of exports from the US internationally, but we're not going to be able to say whether those products came from Georgia or South Carolina, much less what town they came from. So unfortunately, that's it would be very cool to be able to see that. With modern data, you can see interstate trade and all of these things. But yeah, but I agree with you that international trade is not a margin that you would expect to be directly affected unless it was through some more complex supply chain thing.
Yeah. So I think that the final question is going to go to Ray. So Ray, if you want to come in with your short final question.
Yeah, and it's just building up on what you guys were talking, which is what else could have affected international trade? And of course, the biological revolution in wheat cultivation, Olmsted and Brodie, the dramatic decrease in effective trade costs, right? It's not by chance that wheat and oat were quoted in the Chicago Mercantile, right? That's mostly because, and it's not like they happen at this time, right? But they're sort of starting to happen, especially the decline in transportation costs. And this is not necessarily a threat to your identification. It's just, how should we interpret your results, right? It's just purely liquidity effect, or, you happen to have created a new banking sector at a time when a specific agricultural subsector, right, becomes very competitive. And so I would expect that to be more of a direct effect, right? Even if you hadn't created the national banks, even the local state banks might be, interested in lending more, not necessarily not on mortgages for the reasons we described, but on short-term trade credit.
Yeah. So I'll first give a very boring answer, which is if we just think about identification coming from these 6,000 people places versus 6,000 plus people places, it's a little hard to think about why one would differ from the other. But I think a more substantive response, and what you bring up is really interesting, is that I really do think these trends that places are on and other costs that they're facing do really matter. And if you have an accelerator to that, like a financial accelerator to that can change the slope of what those other costs in a really big in a very dramatic way. And that's, kind of how I think about the effects in my other paper, which is that you have a financial shock, but it's happening during a period when there's so much international expansion and trade. And so, being relatively disadvantaged during that period will seem to have very large effects in overall outcomes. And that's not necessarily something that you would see in all periods, right? It does, it is somewhat context specific in the sense of this was a period when all these new relationships are being formed and there are these other reductions in trade costs. So, so getting any sort of advantage in that period of growth is going to be important. And if I'm not mistaking your comment, I think that's kind of conceptually similar. Yeah.
Indeed, thanks.
Okay, well, thank you everyone for coming this afternoon to the seminar. Thank you to Chenzi for presenting her work. It was, again, really enjoyable way to spend the last hour, so thank you for that. A reminder, everyone, next week, the seminar, same time, same place, is Gustavo Cortez and Kerchan Verdict, who are going to be talking about public health shocks and product pricing behavior evidence from life assurance during the Spanish flu pandemic. So that's next week. If anyone wants to hang around for the next, we're going to be here, I think, for the next 15 minutes. If anyone's got any additional questions they'd like to ask, that would be the time to ask. But for everyone else, enjoy the rest of your day.
Okay. Thanks so much, John.
Thanks,
Emily.
So I have a few more questions. So there's a question around competition. So when you've got a national bank setting up, is it setting up in one of these towns and there's already a state bank there? Or is there not a state bank in the town? And so if there's a state bank, then it's increasing competition. It maybe whips the state bank into shape.
Yeah.
So this is going on?
This is something that I should know the answer to right off the bat. But a lot of these new national banks were converted from state banks. So there would be this, just changing the charters. A lot of, I think in this later, but all those conversions tended to happen very early. So it was kind of like, oh, this new chartering system comes in. All the big banks in the major metropolitan areas pretty much immediately convert their charters. And there was this thing, I think this came up earlier about state banks being taxed out. That definitely happened, especially in smaller places. And then, and I think we're in this period where the state bank resurgence hadn't come up yet. So again, going back to Matt Jeromsey's work, I think the resurgence isn't until really the 1890s. And that's when you see this sort of market segmentation in the business that they're in their business models, where state banks find different ways to fund themselves outside of having notes. So they issue more deposits as a way to fund themselves, and then they also tended to be more targeted toward the agricultural sector. So I think that's, broadly speaking, the way my understanding of what people see happening during this period. So I think in this period, like I just summing up and being more concise, in this period, it was more new banks. The very early period was the conversions. And then later on, we see more competition from state banks.
Okay.
Yeah.
Okay. So most of the towns that you look at would only have this one, but there would be one bank towns. In effect. Yeah, they tended to, if you so we rely on bankers directories to figure out what other banks were there, and because the OCC would only tell you if you had a national bank there or not, and if I recall correctly, in those data, once we net out what the national banks were, these tended to be fairly unbanked places. Yeah. And someone may already have done this, but just as you were going through your presentation, thinking about the national banks coming in, so they're not lending on real estate, they're not lending on agricultural land. So then that pushes those potential clients, borrowers, towards the state banks. So does entry of the national banks make the state banks, more risky, more unstable potentially? I don't know if anyone's done any work on that.
Yeah, that's a really interesting question. I don't think I've seen anything like that. I don't remember. I know that Mark's paper, they look at banking stability and they look at bank failures during 1907. So it's kind of like a little bit later. Let's see how well these banks did. I I thought they were just looking at the national banking sector in terms of those measures of bank failures. But maybe it also included state banks. But yeah, it's a, more broadly though, their paper is interested in bank competition. And I think it's precisely this, what you brought up. Yeah.
So Ray, do you want to come in at this stage?
Yeah, sorry to always come back. So your identification is based on these artificial population thresholds, but we can always imagine that there might be some anticipation effects. There's no way to test for that, but could you just do the brute force thing, which is to check whether cities closer to the threshold that got the bank grew faster, but without crossing the threshold, right? So, you have two cities below 6,000. Can you see whether there was, and even perhaps some discontinuity in the growth rate, right? Whether they crossed or not the threshold after they getting this is not rocket science.
So I see. So, okay. So it's kind of the idea is a place that wants.
Yeah, so both places have 5,000 or 5,500, but we know, or the locals knew, that one has better endowments to grow, right? Again, I'm just devil advocating here, right? So it's just trying to push down the relevance of your estimate, even though I believe that, right? But how could we think about that? Perhaps if you observed some kind of kink in the growth rates of the population of the cities, these comparator cities, maybe.
Yeah. So I think this idea of anticipation, it's one of these things where if the threshold worked in the opposite direction of the bigger you are, the better things are, then that would definitely be like, oh, okay, better, places that got this advantage, they were already going to be bigger and they anticipate being bigger. So they're just going to, move forward their decision to live here or something like that. Here, though, it's like, the relatively smaller places did better. So it would have to be like, we anticipate that we'll grow really well, but we're going to hold off on population growth until the next census. And I think that's a little harder to just understand how that would work. I mean, I guess, okay, one very maybe straightforward way to do that would be to claim that you have a new city or a new town, right, within your former town lines, right? Like you can just, if you can somehow create a new municipality. And actually, that is something that we can look at. So I showed you those census publications, and the one I showed you isn't a very good example because they're all at the same sort of unit of size. But in a lot of these publications, you'll see, for instance, for South Abington Town, they'll have like, precinct 1, precinct 2, something like this, and and each of those will have a population with it. And so I think for the purposes of the National Banking Act, that could be counted as a town. So whether we see more of this creation of not false towns, but like smaller areas, that actually might be a nice indication of anticipation.
Yeah, and I'm sure I missed it. It should be in the paper, but you control for the transportation network.
Yeah, we use Donaldson Hornbeck's market access railroad stuff. Yeah, and so we have those in all of the regressions, and
makes sense.
But thanks for bringing up this anticipation. I had noticed and had kind of thought about this fact that you do see these new, I don't know, precincts, areas, subunits, I call them different things over time, and hadn't been thinking about how to use those.
Yeah, and I wish I could be precise, but I recently heard a paper that showed that the growth rate of population in US towns was not monotonic, and that there was a clear kink at the level of small to medium-sized towns. But of course, I should tell you which paper this is. I'll try to find it, and if I do, I'll send it to you.
Thanks, Ray. I appreciate that.
So I was quite surprised, Chenzi, that with the state banks, there wasn't some sort of market solution to the whole counterfeiting, bank solvency risk type of things facing note holders of these banks.
Like private insurance of some
private
sort?
Insurance, clearinghouse associations, private.
Yeah. So what you imagine is that there would be some way to basically get a stamp on the notes that have some sort of backing insurance, and this would be a signal that people could use. So I don't think I've heard of anything like that, but Gary Gorton does have this other paper looking at reputation building for these banknotes over time, and basically using the time series of discounts and showing that as a bank became more known, its notes traded at smaller and smaller discounts. And that was, it fits in this, if we think that these banks are building up their reputation and signaling that everything's okay. So I think you're right that this counterfeiting risk is not homogeneous across banks, and probably not across regions either. And it is something that banks did try to signal in certain ways. I imagine that, for instance, but I came across one of these books that they would publish, like these really big manuals where they basically create facsimiles of banknote designs that they know aren't counterfeit, and they describe them like, oh, lady in the corner, man on a snow sled on the right hand side, these are the denominations, things like that. It's just I think the thing is, like, you just have to be very informed. These are, not everyone would have these books, and they literally are thousands of pages. So I think that's why you have these money changers. It was a nice trade. Yeah.
Listen, I think our time has gone, Chenzi. So thanks again, and really good to see you.
Yeah.
And hopefully
you
see you soon in
too.
person.
Yeah, thank you so much, Ree.
Thank you, Chenzi.
Yeah, it was really nice. And I hope things stay well east of the Atlantic.
Yeah, same to your side.
Thank you.
Right.
Yeah.
See you then.
Yeah, take care.
Take care.
Bye.
Thanks, Ray, Nathan.